Good morning, good morning, good morning, good morning. In this video, I'll be answering the question, what is the funding rate? Everyone wants to use the funding rate in their trading strategy, but very few people seem to understand what the funding rate actually is. And many people who think they understand what the funding rate is don't really. So in this video, I'll be answering the what, the why, and the how. What exactly is the funding rate? Why it even exists in the futures market, and how you can use the funding rate in your trading strategies in a safe and profitable manner the way a professional trader would do so. And at the end of the video, I'm going to be giving you guys 3 different funding rate trading strategies that you guys can start using today. And while many of you guys are going to be excited for these trading strategies, remember, to use them effectively, you first need to understand the what and the why. What is the funding rate? Why does it even exist? Let's get started. Alright, so let's get into it. Let's start with the what. What exactly is the funding rate? And a very simplified way, guys, to think of this is that it's essentially your cost to hold your position. A lot of people like to think of it as an interest rate of sorts, and technically there is an interest rate component within the funding rate, but there's another component that is far more important, and that component is from where you can actually derive your edge, and we'll get into that in a bit. For now, however, understand that the funding rate is at its essence your cost to hold your position. And what do I mean by holding your position? Let's say you take on a trade, you buy some Ethereum, you buy some Bitcoin, you are in a position. That trade is a position. And as we know, there are always 2 sides to a trade. And this, guys, is especially true in the futures and options market. If someone puts on a long trade, there is someone else who has taken on an equal short trade. So the funding rate is the cost that one of these traders is paying to hold their position. And this is very important, guys. Only one side pays the funding rate. And more importantly, that one side is paying that funding fee to the other side. So if you are in a long position and you are paying the funding rate, the other side of the trade, the trader who has taken the short position, is receiving a funding fee, right? So you are paying a funding fee, the short trader is receiving the funding fee. Now you might be wondering, how is it decided? Do the longs pay the fees or do the shorts pay the fees? And a lot of people seem to mistakenly think that the answer depends on if there are far more longs in the market or if there are far more shorts in the market. So for example, people tend to think that if there are far more longs in the market, the longs have to pay the fees. And if there are far more shorts in the market, the shorts have to pay the fees. But this is incorrect. We just established at the beginning of this presentation that for every long, there is one equivalent short. So there can't be a case where there are more longs in the futures market than there are more shorts. And by the way, this is very specific to the perpetual futures markets. So a funding fee is paid from one side to the other only in the perpetual futures contracts. And understanding the real reason as to why one side is paying the other side is very important. People tend to want to counter trade the funding rate based on that incorrect idea that there are more longs than shorts because longs are paying the funding fee to the shorts. And while it's fine to have a counter trading strategy, you need to understand what you are counter trading. And that's exactly what I'll be explaining to you guys in this video, how it's decided who pays the funding rate. Do the shorts pay the funding rate or do the longs pay the funding rate? So this brings us to the why portion of the video. Why does the funding rate even exist? Remember, we said that the funding rate is very specific to the perpetual futures contracts. For example, when you buy Bitcoin or Ethereum or any altcoin for that matter on the spot market, you don't pay a funding fee. In fact, even when you buy Bitcoin or take a position on Bitcoin on a normal futures markets, you don't pay a funding fee. Instead, there is something called a premium or discount. You guys may have even come across these fancy terms like Contango or Backwardation, right? Futures, normal futures, do not have a funding fee. In fact, let me show this to you guys on an actual futures trading platform. Alright, so here we are and we're looking at Deribit, which is the futures trading platform. Now, it really doesn't matter what futures trading platform you're using, whether it be Binance or Deribit, they're all the same concepts. And also, don't let any of this fancy flashing numbers overwhelm you. It seems complicated in the beginning, but it gets easy really fast. In fact, I'll be doing videos explaining all of these fancy terms, concepts, and jargon in an extremely simplified Mango style. So if you guys are interested in those videos, make sure to hit the subscribe and the bell notification icon. We'll also be actually releasing an entire series on FTX very soon. So stay tuned for that as well, and make sure to hit the notification icon so you don't miss out on that. Alright, so getting back into it. Again, there's a lot of information thrown at you, but I want you guys to focus your eyes on this little bit over here that says funding /8H, which essentially means you're funding every 8 hours, and it's currently reading 0%, right? So that's essentially your funding rate if you are taking a long position on the Bitcoin perpetuals, right? We are looking at the Bitcoin perpetuals. So what we're going to do now, guys, is we're going to use this drop down right over here to go ahead and pick one of the futures contracts. You see these dates over here? These dates over here corresponding to the price represent a futures contract that is expiring on that date. The contract right on the top away that says perpetual, that contract never expires, and I'll be explaining how and why that is done very soon. These other contracts over here, these are what I consider normal future contracts. They are non-perpetual, right? These contracts expire. The perpetual contracts never expire, right? And we're going to go ahead and pick the contract expiring on the 31st of December 2021. You're going to notice two things, okay? The first thing is that right on the top over here, where we had initially seen a segment called funding /8 hours, instead we are now seeing a premium, right? There is no funding fees paid on futures contracts that actually have an expiration. Instead, you are paying a premium. Another thing that you may have noticed right off the bat, and here you can essentially see just through the drop down, guys, is that the price of these contracts, right, that are expiring in the future have a different price, or usually have a different price compared to the perpetual price. The perpetual price is currently going for 57,600, right? The contract expiring on the 31st of December is 58,200. If you go all the way to next year on September 2022, you're going to see that the price is $62,000. Why is that? And what does this premium mean? And how is it different from the funding rate? For that, we're going to go back on over to the slides so that way we get away from all of this complication, this jargon, all this information thrown at you. We're going to keep it simple. We're going to keep it Mango. Alright, so we're back on over to the slides, and this time we're going to be working with an empty slide and my trusty drawing tools. For those of you who are in the Mango C program, you guys know how I just love my empty slides and drawing tools. It makes learning a lot more fun, a lot more interactive. So to recap, we just saw that on the Deribit futures trading platform, the contracts that were expiring in the months to come were trading at a higher price than the perpetual contracts. But if you guys compare the price of the futures contract to the spot market as well, you guys are going to see that the price differs. So for example, let's say the price of Bitcoin or Ethereum has a upward trajectory like this on the spot market. Now you guys are going to notice that on the futures market, the price is actually going to move either like this above the price of the spot market, or it's going to move underneath the price of the spot market. So it's either going to be trading at a premium to the spot market or at a discount to the spot market. Remember, the spot market right over here is depicted in white. The futures market over here we have in blue if it's trading at a premium, and pink/red if it's trading at a discount. And by the way, guys, this is where the terms backwardation and contango come from. So if the market is trading at a premium, it's known as contango. I'm just going to write that down over here. And if it's trading at a discount, it's known as a backwardation. Now, I'll be doing a separate video that explains both of these concepts in deeper detail, and the goal of that video is to show you guys how you can put on risk-free profitable trades. Yeah, you heard me, risk-free. And those are especially useful when you want to take profits in a bull market and you don't know what to do with that cash. Alright, so now getting back to the slides, futures markets can either trade at a premium or they can trade at a discount. Now, futures contracts can be extremely useful instruments, especially for businesses who are looking to hedge to avoid any massive losses or massive opportunity costs. However, while they have their advantages, futures contracts also come with a lot of inconveniences that may be troublesome for some type of traders and speculators. For example, as a trend trader, we have to undergo what we call rollover risk. Just to put it very, very simply, as a futures trend trader, I might be looking to essentially put on a position at a particular date where it's trading at a premium to the spot price. So let's say it's trading maybe $1,000 above the spot price, correct? So I pay a premium to enter that futures contract. But as the contract starts maturing and reaches its expiration date, the price, or rather the premium, will collapse down to the spot price, right? So the premium gets eaten up. Now I have to roll over when that futures contract expires, and I want to still stay in that position, because remember, as a trend trader, I'm looking to stay in my position for as long as possible. So when that contract expires, I may have to roll over my position to another month's contract, and that contract may be trading at a much higher premium yet again. So what did I end up doing? I ended up buying at a premium, selling at parity with spot, and then buying at a premium again. So I end up losing out on that chunk, that difference of the premium that I paid on the rollover. This is known as rollover risk. In fact, I can go ahead and show you guys that on the Deribit platform very, very quickly, because at the time of recording, we are lucky enough to see a contract that is expiring very soon, and you guys are going to see the price of the futures contract converging down on over to the spot price. Alright, and here we are back on over to Deribit, and again we are looking at the BTC perpetual contracts currently trading at $57,455. The current date at the time of recording is 26 November 2021. Fortunately, for the purpose of this recording, we have a contract that is expiring today. And look at this, guys. You guys can see that the 26 November expiration contracts, essentially expiring today, are trading at parity with the perpetuals at 57,455. There's practically no difference whatsoever. Now, here's where things get interesting. Let's say that I was in a trade on this particular contract, okay? I'm a trend trader and I'm in a trade, and I put on this trade maybe 3 or 4 months ago. And at the time when I put on the trade, I paid a premium to enter that position. So let's say Bitcoin was trading at $40,000. I paid $45,000 to enter the position, all right? I paid a $5,000 premium to enter the position. Now today, my contracts are expiring, right? These contracts are expiring today, and I want to still hold on to the position because I'm in a profit. I want to hold on to my trend trade. I'm looking for much bigger gains. Now, Now, to hold on to that trade, I would have to roll over these contracts. And to roll over these contracts, I have to essentially sell these contracts today and then rebuy one of the future month expiration contracts. But here's the thing. If I were to now pick one of the future months to rebuy my position, I would have to pay a premium yet again. And this is after I sold at parity. So in essence, I would be selling low. So for example, I'd be selling at 57,000 at the current price. And then to buy one of the future month contracts, let's say the June contracts, I'd be buying at 59,900, almost 60,000, right? So that's like a $3,000 premium I would have to pay yet again. So as a trend trader, this could eat into my long-term profits in a long-term trend. This is one of the inconveniences of trading the futures contracts. You have to roll over your position, and depending on the market conditions, you may have to face some rollover penalties. Perpetual contracts, on the other hand, do not ever expire. They trade in perpetuity. That's why they have the name perpetual contracts. They were designed to constantly trade without an expiration and to trade as close as possible to the spot market price as well. So they don't have a premium the way that the normal futures contracts do. Because remember guys, if we switch on over to the December contracts right over here, the futures contracts expiring in December, we are going to see that it's trading at a premium, right? A 10% premium at the moment. Now, if we switch back to the perpetuals, we're going to see that we don't have a premium, but instead we have a funding rate right over here, right? Currently, the funding rate is positive, right? And that means that longs are paying shorts. So when the funding rate is positive, longs are paying shorts. When the funding rate is negative, the shorts are paying longs. And that's the core difference between the perpetual contracts and the normal futures contracts. They don't expire, they don't have a premium, so to speak, but instead they trade in perpetuity and they have a funding rate. Okay, and again guys, this funding rate that you're seeing right over here that is currently indicating that longs are paying shorts is not because there are more longs than shorts. And to understand how this funding rate is decided and how to decide who's paying who, let's go back on over to our slides. Alright, so here we are back on over to the slides and with our trusty drawing tools as well. So now that you guys have a basic understanding of how the normal future contracts work, we can now talk about the perpetual contracts and how the funding rate has a very, very important role. So, quick recap. Future contracts tend to trade at either a premium or a discount, right? Contango or backwardation, and this can get inconvenient. The perpetual contracts are designed with a very clever mechanism to allow the contracts to constantly trade at parity with spot. Remember, the white line over here, guys, represents the spot price relative to the futures prices over here in blue or red, depending on whether we are trading at premium or discount. Let's go ahead and redraw the same thing, but now do it with the perpetual contracts, okay? So let's say the spot price is trading again, similar direction like this. The perpetual contracts now are designed to track the price of the spot price. But because this is a futures contract and there's leverage available at the speculator's disposal, these contracts tend to trade a lot more aggressively. And this is the crux of it, guys. Because there's leverage available, because traders can be a lot more aggressive, the price tends to drift away from the spot market. But as soon as it does, the platform upon which these contracts are trading, they say, no. We're not going to let that happen. We designed these contracts so that the price tracks the spot as closely as possible. So what do? They put in incentives for the market to push the price back towards the spot price. So if the market trades underneath the spot price, they'll have incentives for the market to push the price back up towards the spot price. And what are these incentives? Where does it come from? Well, it comes from the funding rate, guys. So let's break this down very, very simply, all right? Let's go through an example. Let's say the price of the perpetual contracts drifts away above the spot price. All right, so it's trading slightly above, you could say at a premium to the spot price. In that case, the platform that you're trading on, whether it be Deribit or Binance, they're going to set the funding rate positive. And remember, positive means that the longs are paying shorts, correct? So the longs are paying money to hold on to their position, while the shorts are getting paid money to hold on to a position, right? So let's go ahead and note that down. Longs in this scenario are essentially going to be paying money to hold on to their position, while shorts on the other hand are going to get paid to hold on to their position, right? So let's go ahead and note that down. All right, so I want you guys to think about the incentives now that both of these market participants have. Since the longs are paying money to hold on to their position, they're less incentivized to be as aggressive, right? They're likely going to close out some of their positions or maybe all of their positions depending on how high the funding rate gets. When longs close positions, what are they doing? They're essentially selling into the market, right? Closing out a long means selling into the market, right? That creates downward pressure onto the price. So the price converges back towards the spot. And on the flip side, guys, the shorts are getting paid to hold on to a position. So if there were traders who were on the sidelines, who were contemplating getting into a short position, now they're incentivized a tad bit more to put on that short position because they're getting paid, right? So shorts, on the other hand, they'll put on a position. So this is going to cause more shorts to put on new positions. And what are shorts doing when they're putting on positions? They're selling into the market, correct? So there's even more sell pressure coming down for the price to come even closer towards the spot price. So when the funding rate is positive, we have longs looking to close out positions, essentially selling, and shorts to put on positions who are also selling. So we have sell pressure coming in from both sides to get the price back towards the spot price. The flip side happens when the price goes underneath, right? Now suddenly the funding is negative. So now longs start getting paid and shorts are paying to hold on to their position. When a short position is paying to hold on to a position, what is he thinking in his head? He's now feeling incentivized to close out the position, or at the very least, not put on more positions, right? So if some of the short positions decide to close out the position, they are essentially deciding to buy into the market. Remember guys, closing out a short position means you're buying into the market. So this causes upside pressure. And again, if there was more money on the sidelines who was contemplating putting on long positions, they were just a bit uncertain. Now they are a tad bit more incentivized to put on that position, correct? So what happens when they actually do put on that position? They are applying more buying pressure, right? So we have price move back towards the upside, towards the spot price. So the funding rate, guys, acts as a disincentive and a incentive for the market participants to push the price back towards the spot price. So for example, if the market trades above the spot price, longs are going to be paying shorts, right? It's not because there are more longs than shorts, guys. I must reiterate this. It's because of the aggressiveness of the longs. The longs are being aggressive on the order book. They're just taking whatever price that is on the order book. They're not waiting to get filled. The leverage allows them to express their bullishness on the market. And the funding rate acts as a balancer, as an incentive mechanism to keep their aggressiveness in check, to ensure that the price stays as close to the spot price as possible. So now that you guys understand what the funding rate actually is and how it actually works, we can now talk about how you can use it to your advantage in your trading to put on more informed decisions. And this takes us very nicely to the how section of this video. So let's go ahead and hide our drawings and switch on over to the next slide. So what exactly is the funding rate telling us? How do we use it? So the first way is to get a read of the current sentiment of the market. Remember, in the previous slides, we talked about how the funding rate is adjusted to be either positive or negative depending on whether the longs are being very aggressive and taking bids off the order book, or whether the shorts are being very aggressive and taking bids off the order book, right? So it's giving you an idea of the market behavior. Remember, it's not that there are more longs or shorts. It's giving you an idea of their behavior, of their psychology, of their mindset. So that can add edge to your trading strategy, because information on its own is not edge, but the insights derived from the information, guys, is what gives you edge. Now with this video, now that you guys have an understanding of what the funding rate really is, you guys can derive insight from the information that the funding rate is giving you, right? And when you combine this with the rest of your indicators, with your entire strategy, this can be very, very powerful. Would I recommend using this on its own to counter trade sentiment on its own? Absolutely not. Using it in conjunction with everything else that you are looking at can give you additional edge to be able to take more confident trades. Now, the next method I'm going to be showing you guys can be very powerful on its own to add significant more edge to your current strategy. And this is something that I've used often, especially more recently in the current market conditions. And this is essentially trend divergence or confluence along with the funding rate. And what do I mean by this? Well, essentially, you want to be looking for confluence between the market trend, the direction of the market, along with the funding rate. So for example, let's say the current market condition is going towards the downside, right? It's trending towards the downside, but funding rate is consistently positive. It means that the longs are consistently, aggressively taking up the offers that the sellers are providing, but the market is not resolving in the direction of the longs, even though they are being aggressive. So over here, we are not seeing confluence. We are seeing divergence between the funding rate consistently being positive compared to the price going towards the downside. And that is essentially telling us that the longs are being aggressive with their buys, but the market is not moving in their direction. This is not an environment that I would want to be long in, because the current longs are going to be feeling a lot of pressure on their positions. Think about it, guys. They are holding on to positions that are moving towards the downside. Think about it, guys. They are holding on to positions that are going into losses because the price is trending down while they are paying to be in that position. So they are paying to be in losing positions. So it won't be long before they feel the pressure to get rid of their positions, adding on over to more sell pressure towards the downside. Now, the opposite is also true. If we see price trend towards the upside while funding is negative, this isn't an environment where I would want to be in a short position. And in fact, if I were already in a long position, I would be more likely to hold on to that position because one, I'm getting paid for that position, and two, these short positions are going to be feeling a lot of pressure to let go of their short positions, and to let go of those positions, they would essentially be adding buy pressure onto the market in an already uptrend, and this could cause an impulsive move towards the upside. And this is precisely what happened with one of our trades recently on, believe it or not, guys, Shiba Inu. I was in a nice trend trade on Shiba Inu. Notice that the funding was aggressively negative while price was moving up. That led us to hold on to the position for a little bit longer to get another 100% towards the upside. Alright, and now for the third way you can take advantage of the funding rate. And in this strategy, you'll be essentially trying to capture only the funds that you receive from the funding rate while you're neutral on the direction of the actual asset. And you could call this the funding rate trade. So let's say, for example, you notice that the funding rate is currently positive. When the funding rate is positive, it means that the longs are paying the shorts. Essentially, the shorts are getting paid to hold on to a position. So what you could essentially do is first go on over to a spot exchange, for example, like Coinbase, and put on a long exposure trade. So essentially you'll be buying on the spot market. So let's say on the spot exchange, all right, I'm going to write down over here spot, you'd have long exposure, correct? So an up arrow for long exposure. Then you go on over to a perpetuals exchange like Deribit, for example, and you put on a equivalent position size short position, right? So on the perps exchange, you'd be putting on a short position. Now here's the thing, since you are long on one exchange and you have an equivalent position on another exchange that is a short position, these positions offset each other, right? So if the asset goes up in price, it doesn't matter because you are short the same position size on the other exchange, the perpetuals exchange. But remember, the perpetual exchange is paying you to be in a short position. So even though any asset appreciation or depreciation is negated by your perps short position, you are still receiving the funding rate fees. So this is another sophisticated approach to take advantage of the funding rate without having actual exposure to the direction of the asset. But keep in mind, guys, there is opportunity cost and counterparty risk associated with this trade. For example, you could have used those funds to be in another asset. That is opportunity cost. Counterparty risk, you putting your funds on the perps exchange is counterparty risk. By the way, if you guys are interested in a full step-by-step video where I show you guys how to put on this trade, then let me know by leaving a comment down below and hitting the like button, and I'd be glad to do one if there's enough interest. Alright, and this brings us to the wrap-up portion of this video, and if you've gotten this far into the video, give yourself a massive props because it proves that you're one of the few people, the minority, who are actually looking to learn what's important as opposed to looking for just calls and quick results. And believe it or not, people like you are really hard to come by. So if you haven't done so yet, please come join us at our Discord, be part of the family while we go through this learning journey together. And with that, let's go ahead and get to the wrap up. What have we discussed so far? Well, we discussed the what, the why, and the how. What is the funding rate? Why does it even exist, and how you can use it in your trading strategy? What is the funding rate? It's essentially your cost to hold your position. Remember, only one side pays the funding rate. Either the shorts pay the longs or the longs pay the shorts. Why does the funding rate even exist? It exists as a mechanism to incentivize the perpetual price to trade as closely as possible to the spot price. Remember guys, in a normal futures contract, the futures either trade at a premium or at a discount. The perpetual futures contract was designed specifically to trade as closely as possible to the spot price, and this is done via the funding rate as explained throughout this video. And finally, we discussed 3 ways how you can take advantage of the funding rate in your trading strategies. The first strategy was using it as a simple vanilla counter sentiment trading strategy. The second method was to use it in conjunction with your trend analysis to find either confluence or divergence. And the third method was a market direction neutral strategy, where you're not trading one direction of the market or the other, but instead you're trying to capture the profits from the funding rate alone. In fact, when you now combine everything, you guys can now see how traders who come in to only capture the funding rate also take part in the funding rate incentive mechanism by simply taking a neutral position. So for example, if the perps start deviating above the price of the spot, the funding rate is going to increase for the longs. This is going to incentivize traders to come in and capture the funding rate trade, right? So how do they do this? They essentially go ahead and put on a short position on the perpetuals exchange while putting on a long position on the spot exchange. So their sell pressure is only on the perpetuals exchange, right? Because their offsetting position is on the spot exchange. This adds further downward pressure on the perps to incentivize the perps to trade closer to spot. When you think about it, guys, the funding rate mechanism is so beautiful and so elegant. All right, so That wraps it up for this video, guys. I really hope you guys enjoyed this video. I hope you found it informative. If you did find this video informative and you enjoyed it, please let me know by hitting the like button and leaving a comment down below, because it will really motivate me to do more of these videos. With that, guys, do it the mango way, do it the easy way, do it the stress-free way. I'll see you guys in the next video.